Good evening and welcome to tonight's live webinar where we look at the ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals offers a broking account with a number of different model portfolios. So a model portfolio based on the ASX 20, the 50 or the 100. Also the US S&P 100. We have an ASX and US high conviction strategy, which picks up the ideas expressed on the daily blog. And we also have a new exchange traded funds iShares model. Within the broking account, we can run an independent portfolio where we work in partnership with you to execute ideas that we agree on together. And we can use derivatives to enhance the portfolio return, so using covered calls or buying puts as protection on the downside. If you'd like to know more about an Investor Signals broking account, please call me on 1300 614 002. Visiting the website, you'll find information on our research service, which is the technology that I'm using tonight. You can subscribe to that for $1,320 a year. If you'd like to have a look at the Investor Signals broking account, click on the online broking link, or we have a managed fund. So again, if you'd like to know more about any of those services, please give me a call. And as I mentioned, the technology that I'm using tonight you can subscribe to for $1,320 a year. This is a graph that we've looked at in prior weeks, but just to refresh everyone's memory, the red line is the current sell-off in the market, albeit a small bounce back. This is sell-offs during prior recessions and the duration of them. So something that we're constantly monitoring at the moment is understanding whether this shock to the economy sends it into a recession, which has a time sort of duration similar to other past recession. So this is the year that the recessions took place up the top, and you can see there, roughly half of the recessions have sort of gone somewhere between sort of at least extended past 9 months, and have fallen either 30% or in some cases extended sort of more out to 18 to 30 odd months, 32 months, and the fall's been greater down to 50%. So part of what we're looking at in the market at the moment is obviously just trying to keep an eye on the flow of a combination of earnings data and technical trends in the market to give us a bit of guidance as to how the market plays out over the next 6 months. The table up on screen again is something we've looked at in prior recordings, but just to revisit this helps tie in the average earnings for the S&P 500 to index levels, and obviously these are my rough notes down the side here. But you can see here, coming out of the GFC, earnings for the S&P 500 companies were averaging $60, and that was up from about $20 in 2008. So it accelerated quickly from the trough in '08 when economic activity largely come to a standstill. And it's hard to imagine that the June quarter is actually going to be too different to maybe that worst period in 2008, and that will be something that the market will have to digest when July earnings or June quarter earnings come out in the first week of July. At the moment, the earnings coming through from the S&P 500 companies only capture a couple of weeks, obviously, of the impacted economic period. So still at this stage, I think analysts are still grappling with what do earnings look like in the June quarter, and what does that recovery rate look like, and there's a number of variables that continue to impact that. But if we have a look at sort of how the recovery from '08 started, again from $20 of earnings up to $60, then we sort of had a rough consolidation period for about 3 years there at roughly, say, just under $100 of earnings per share, and the index mostly traded around 1,500 points. Then we had a period of another sort of 3 years of consolidation, roughly around $115 of earnings per share. That put the index at 2,000. Throughout this time, as interest rates are going lower, it's obviously helping to support valuations as well. So you're getting PE expansion on top of earnings growth. Then we get into a period here where the S&P's averaging $130. It's 2,500 points on the index at that point in time. And then in 2018, the tax cuts bumped that earnings growth up to 160, and the index, in an environment of low interest rate, trades up to around 3,000 points. So 2020, it would seem plausible that obviously these earnings are probably going to be a minimum of 20% below where they are here. So you would think the consolidation range is something more like 2,500 points. Obviously, if the market can be optimistic that earnings are going to re-accelerate or at least stabilise, and we've got a lower interest rate backdrop, maybe that support around that level can hold. The big question mark is, what does 2021 earnings look like? And at the moment, analysts still have fairly high forecast targets for 21, up at around $180 of earnings per share, and the probability of that being reached is very slim. And I think in the coming quarter we'll start to see analysts downgrade 2021 earnings. The current short-term picture of the market, up on screen there's a graph of the S&P futures, and really not to get too sort of hung up on this, but what I'm trying to just show here is that the S&P index in the US has ran into what possibly will be resistance at just under 3,000 points. And starting Friday night in the US, we just started to see the market roll over. And we just want to keep an eye on this picture. It could be a continuation of what we've seen here, where you get a little rollover and then a continued push higher. But again, given that we're coming into a quarter at the end of the June quarter, obviously earnings announcements in July, it seems unlikely that the market should push too much higher than where we are at the moment. If we have a look at that on the Nasdaq, so the same thing there, following Friday night, you start to see the Nasdaq roll over a little bit. So again, we just want to keep an eye on, at the moment, sort of that's a reasonably bullish structure moving, with higher highs and higher lows. But from a valuation standpoint, the market's probably pretty close to resistance, it would seem. A longer term graph of the Nasdaq. This is something we're watching, where the algorithm engine switched from buy conditions down the bottom to sell conditions up the top, and we're thinking that the Nasdaq runs into resistance there at around 9,000 points, which obviously has broader implications for global markets. This is a performance of our algo model. So the 5-year average on the ASX has been running at around 9%. The March quarter was down in line with the market, but we've obviously seen a rebound there. If you're following the model portfolios, and I'll show you how to turn those services on when we go into the technology, into the members area tonight. These are the type of messages you get. So when a stock's either added or removed from the model, and you can see here the time duration of holding these positions. It's more of a long-term momentum investment strategy that our model portfolio operates. But you get these notices both on the buy side when a stock's added into the model, or when a stock's removed from the model. Obviously the sell order summarizes the holding period and the dividends. You can see there Evolution Mining was an example. We held it for 2 years, delivered a 64% return. So as we toggle through the charts tonight, we can take a closer look at that. US equities been averaging 10% per annum. Again, March was down, quarter was down 11%, but obviously that's rallied back substantially in April. This is a new ETF model that we have, a new model that we have in our broking account, which tracks the ETFs listed on the ASX. So you can see here that this is the performance of the XJO, and here's the performance of the ETF model. So it's outperformed over the last 10 years by a wide margin. The sell-off has been about the same, but again, you're picking up sort of some of that rebound. But as a longer-term strategy, getting exposure to a global theme, the algorithm model creates a bit of discipline on the sell side as well as on the buy side of participating in these ETFs. So again, if you'd like to know more about that, you can give me a call and I'm happy to provide you more details on it. Okay, moving straight into a graph of the Nasdaq. So this is sort of our backdrop that we're keeping an eye on, and just cautious that the US tech stocks are getting a little expensive. We've seen tech earnings fall in past recessions in 2000 and in 2007. Tech certainly didn't get through unscathed. The market's pricing tech stocks at the moment as if they're a defensive consumer staple. We're a bit cautious on that theory, and we're just watching to see whether the market continues to struggle below that 9,000 level there. So periodically I'll update you on the blog as we start to see that picture play out. Our local market, if we have a look at the XJO, so we've had certainly not a bounce back as strong as the US equity market, and if we're of the view that the Nasdaq is nearing resistance, we also have to be a bit cautious that the XJO up at around 5,500 points may be nearing resistance as well. When we think about the impact that banks and resources have on the XJO, we can sort of pause when we go through those names this evening and just think about what's required to drive the XJO index higher. So during tonight, what I wanted to do is we'll focus on the opportunities in review, and we'll do that by toggling through the ASX 100. So we go to the watch list, go down, select ASX 100. We arrange it in percentage gain to the top. We get it in stocks that are under buy conditions, and we'll move through these first, and then I'll just pause and comment on the names that I think that you want to make a note of. So Afterpay, we've seen the rally in Afterpay following Tencent, which is a Chinese large technology conglomerate that's taken a 5% equity stake in Afterpay. I think that really sort of adds weight to the longer term value proposition there in Afterpay, and it's a stock that's under algorithm buy conditions. You can see here that the last sort of buy signal, or the prior one there, was at 26. We had a further sort of buy signal through this period here, and the stock's pushing higher at the moment. Cube, so they've just moved to shore up the balance sheet with a capital raising. The market's responded favourably to that, and for the moment I would... our view, so Cube's in the model portfolio. You can see there it's switched from sell conditions to buy conditions. So it's been in the model from around $2.30 going back to 2018. So it's pushing a little bit higher than that at the moment. It's not a stock that we're active in on a short-term trading standpoint. Newcrest, I think this is one you want to make a note of and take a closer look at. Newcrest has moved to raise capital, again shoring up the balance sheet. We think gold performs well in a low interest rate environment. The correction in Newcrest from 37 back down to $20, $20.50 thereabouts. We've now started to see it rally. This is one that we've been buying on the dips throughout sort of this move higher, but even the pullback here from $30 back to $25, we think that's a buying opportunity there in Newcrest. Same with Northern Star, a buy at around $12, so make a note of that. APA Group back up against resistance. We don't see too much upside here, but you're getting almost a 5% dividend yield there, and the company was growing earnings about 6% going into this sort of COVID impacted period. The ASX, the trading volume for the last month or so is going to be above average, but on the other side, maybe some corporate actions with new listings gets impacted. ASX, we're comfortable as a defensive financial services business, but owning it and selling covered calls is the way to go there to drive extra income out of it. Ansell at around $28. We'll expecting that to consolidate and move sideways from that level. Telstra, we had this flagged as sub $3 as a buy. It spiked under that today, but the view there is broadly, you can see on the graph I've marked sort of the range. Today's low very well may provide a support level, but sort of somewhere between sort of that 280, which was the prior low, up to sort of where we're trading at the moment, should be a support level for Telstra. Earnings will be impacted, and we're looking at other global telecommunication companies that have reported earnings or revised guidance, and for the most part, you're seeing about a 10% fall in guidance. So you would have to take a read through there to Telstra that maybe has some sort of similar impact. But at around $3, Telstra starts to look okay value. For longer term investors, you've still got the potential of the company splitting their infrastructure business away from their retail side. And I think from a timing standpoint, when we looked at that, it's probably something more towards the middle of next year, but we're certainly getting closer to that outcome. Sorry, just going back to CSL. So a number of analysts have downgraded their outlook for CSL marginally, but it's still one of the more attractive growth opportunities in the market, and happy to look at buying it there around the 300 level. Westpac cautious there across all the banks. We've seen Westpac suspend their dividend and announce substantial profit cuts. Transurban back up near full value. I've spoken about that we shouldn't see an environment where this just roars back to $15. Sentiment wise, we're going to, as the economy reopens and people return back to work, it's going to be hard to distinguish the difference between just positive sentiment around some sense of normality returning versus the actual underlying business and the earnings impact that they're having to deal with. So Transurban's not just Australian toll roads, it's American toll roads. We're still seeing high cases of COVID complications being reported in the US, and there's still some level of uncertainty as to how quickly states reopen in America, and if people have less money or less employment. Obviously that has an impact on whether they choose to drive on a toll road if it's optional, or just the sheer volume of cars and trucks back on the highway. So all things being equal, you would be more inclined to think that Transurban consolidates around this sort of 13 odd dollar level, but reasonably comfortable with the downside risks there. Goodman Group within the property trust still maintain that this is one of your better exposures. So if we look back at the algorithm model there, switch from sell conditions to buy conditions there at around $10, and it's continued to move higher, and we're still under buy conditions. Coles, we like this. Coles and Woolworths, I think there's a strong argument that owning them at these levels and selling covered calls over them, you're driving about 8 to 10% cash flow plus the franking credits. We think the downside risks in the stock are relatively low, so on a risk reward basis, having these in your portfolio with covered calls makes sense. Same with Woolworths, so we've had a correction from up at around $43 back to $35. So we have flagged that sort of buying at around that $34.50 was the level that expressed on the blog, and still comfortable that the stock finds support there. A slight push higher in the share price, and you'd want to look at selling covered calls over it. Obviously the earnings results for Coles, or the earnings updates for Coles and Woolworths, showed above average growth as the pantry stocking occurred ahead of the lockdown or the COVID impacted period. So whether earnings taper off a little bit, but even if earnings grow at sort of 5 to 6%, you're getting around a 3 to 4%, 3% yield in Woolworths, slightly higher in Coles, and the consumer staple side of it provides a defensive mix there. AZJ, owning it and selling tight covered calls, we don't think there's much in the way of earnings growth. So coming into the COVID impacted period, we had AZJ paying out 100% of their earnings in dividends. So we just don't see that there's upside potential there in the share price. We think earnings sort of remain flat at best. So it'd be nice to buy it at lower levels, sort of between that 4 to 425 as I've marked on the graph there, rather than chasing it higher. Not doing an Altium at the moment. Xero, good business here. Obviously this is one that we spoke about earlier on the blog at lower levels. It's rallied since then, but I'd expect that $75 support level to hold for Xero. NAB, we're just avoiding the banks at the moment, likewise with AMP. ResMed, support there at around $23. Again, like CSL, we've seen a number of analysts downgrade the earnings outlook for ResMed. Trades on a high PE. The the way to think about this is really as long as it holds above that $23 level, you're happy to stay on the long side of that. CBA, cautious there. We think maybe there's further bad news to come with CBA. Lendlease, so we saw them move last week to raise capital at I think around $9.80 from memory a share it was. Shores up the balance sheet. The long-term development pipeline for Lendlease is very attractive. The sort of short-term impact of on the global economy at the moment creates some question marks over Lendlease. Mirvac not there at present. Cochlear, I think this one you want to stop and have a think about this at $180 should be support level. They moved early to shore up their balance sheet, so support there at around that sort of 174 level, and you might be a bit more cautious if it breaks below that. Oil Search not doing there. Our preference still remains Origin and then Santos. Wesfarmers, we're not really comfortable with Wesfarmers at the moment, so we think maybe the impact to earnings could be a little bit higher than the market's pricing in. Caltex, this is a way of getting some exposure to that sentiment recovery, as things as the economy or business just returns back to some level of normality. I think sentiment-wise, Caltex is a beneficiary of that. Stop losses below that 21.30 level, but there was a takeover deal on the table, as we've discussed previously, up at around $35. It's been withdrawn for the moment, but the due diligence that was completed on the deal never showed up any material issues. So, in a normalised environment, we may see, maybe revised at a slightly lower level, but there's corporate activity there that should support Caltex, so happy to continue looking at that. So Santos, slow recovery in oil prices, so Santos and Origin and Woodside should all benefit from that, but again our preference is Origin then Santos. So I've just flagged there that you've got sort of supported around 380. A break below that, you'd be cautious again on it. Coca-Cola earnings result disappointed, as we saw in the US with Coke there. I think Coca-Cola in the US had earnings down about 25%. I know Coca-Cola Amatil, when they provided their update, earnings were below analyst estimates, but back down at around $8 is a bit of bad news priced in. That's probably okay as an income trade for portfolio game, buying it and selling tight covered calls. Ramsay Healthcare, zero growth for this year, so back at $62 it's fair value, but you can certainly hold it and collect the dividend, but we don't see too much upside there. Cautious here on NIB Holdings, that we saw the earnings falling substantially coming into this tough economic period. Computershare at around $11, reasonably comfortable with the risk reward here on Computershare. So again, it's a name you could buy and sell covered calls over and run as an income. James Hardie, support there at around $17.50. You could have a think about that with stops below. Both James Hardie and Boral should be beneficiaries of sort of medium term government response to help stimulate employment, but we're probably a little bit early yet for that, but within the next 3 to 6 months we're likely to see commentary around that. BlueScope Steel, hard to sort of get too excited about that in this environment. Sydney Airports, we think there's still some risks there, and like Transurban, it's hard to build an argument that it just rallies back to where it came from. We think that the impacts are material on this year's earnings. And little visibility as to when the earnings at those prior levels return. So Brambles, they provided a trading update only a few weeks ago, guided towards slightly lower earnings, but still in the range of sort of 5 to 6%, which is extremely good in this environment. So this is a stock that you want to keep on your watch list and buy on a dip. Now, depending on how the market trades in the US over the next couple of nights, but around that $10 level I've marked as support, and I think if you could buy Brambles marginally below that, we'd be comfortable with it in this environment. Magellan, support there at around 45, but it's not a stock we're active in at the moment. Macquarie, reason to be cautious there, so we'll just I'll update you on the blog if we're building positions, new positions in Macquarie. REA Group, we like this within that tech basket that we've reviewed a number of times, but car sales, REA and Seek, out of the listing data, when we analysed it, car sales seems to be holding up the best as far as listing volumes go. BHP, we'd been cautious on iron ore prices, sort of pushing back down to the lower end of that $80 bound, and you've seen softness in BHP and Rio. So, in order for the XJO to move higher, we need a more optimistic outlook to the banks and a better iron ore price. Both of those things don't seem likely in the short term, so again, we'll sort of be guided by how that Nasdaq index in the US trades as an overall sentiment gauge towards the market. BHP, at around that $28, we're assuming that that's sort of fairly close to fair value there. And again, if you're holding it in portfolios, we think the upside growth's limited, so you could sell calls, to drive extra income. Not doing there in the regionals at the moment. Downer EDI, you're seeing increased commentary around the government's response with looking to approve small-scale infrastructure projects as a way of helping to stimulate the economy. At the margin, Downer's going to be a beneficiary and a participant in that, but we know that there's also going to some concerns around bad debts in the business. So if you're looking at this particular stock, I've just suggested maybe just a simple trend line below these session lows, and if it breaks below that, or maybe takes out that prior low there, you may want to be a bit more cautious on Downer. Medibank Private probably bumps along sideways a little like NIB. We think the dynamics there where the actual hospital costs are going up, as it seems like they're having a hard time keeping premiums in line with rising expenses. Sonic Healthcare, so this should be a significant recovery opportunity within an economy that slowly starts to reopen. And it's not just Australia. Sonic's obviously in Europe and America as well. The higher low formations here, we're buyers of it at 22, we're buyers of it again here at 24. I think sort of anything back down between that 26 and $25 level provides a good entry point again for Sonic Healthcare. Aristocrat, just flagging that you got support there at around $21, but not one that we're too active in. But all of these are stocks that sit in the ASX 100 model portfolio. Origin Energy, so we saw another strong day off a session low there at around $5, but the Australian Pacific LNG project continues to deliver increasing dividends to Origin. The retail electricity side's obviously had a slight fall off in earnings, but the LNG project there continues to unlock value. We don't see upside much above sort of $5.50 to $6 over the coming months, but should be well supported there. Not doing it there in Dexus, nor in Atlas. Amcor, it's an attractive business because a lot of the packaging's around food, consumer staple type products. Online distribution of products is increasing and requires packaging. Amcor did the merger with Bemis in the US, so there's some cost synergies there still coming through. But as I've spoken about, going into this, the underlying earnings growth of the business was relatively low. It was only tracking at about 1% or 3% earnings within that range. So you would have to assume that earnings are going to be impacted negatively somewhat from the current environment. So, we've had a view here that around $14 is resistance. We like the story, but would want to buy it at lower levels. If you do own it, selling covered calls and driving the extra income. TPG, so had a target there of sub $7. We're happy to take another look at TPG, so happy to add that one to your list and keep an eye on that. GPT, a little hard to get excited about office trusts at the moment. JB Hi-Fi, so we've just put high or low there at 31 and tracking to see whether that support level holds. So Cleanaway, this is one that, again, get you to add this to your notes or your watch list. Buying it somewhere, again, nice to pick it up at sub 170. But we think the longer term fundamentals there are good for Cleanaway, so happy to add that to portfolios. Car sales, buy on a dip, we like that, and everything we read on the listing volumes seem to be holding up okay. Star Entertainment, so we're seeing what looks to be a preparation of the reopening of these businesses, but again, it's an unknown quantity as to how fast normal revenue levels return, especially given the impact of international visitors, and then obviously just the general domestic business, how quickly that returns to normal. So it's just hard to see Star or Crown getting back to those prior revenue levels in the next 12 months. Oz Minerals, we like this as a commodity play, so buy on the dip, sub $8. We're happy to take a look at that. Rio, just worth pausing and having a look here that we've seen the price correct, roughly $10 just over the last couple of weeks, and that was sort of in line with the view that we're a bit cautious on iron ore moving down to that lower end of that $80 band. But we'll keep an eye on Rio as a buying opportunity, and I'll update you on the blog if we enter or when we enter new positions there. Qantas, we've seen Berkshire Hathaway exit all their exposure to the airline industry, so you question why we would know better than Warren Buffett. One of the pluses for Qantas is when travel does return, they may be one of the sole survivors. So we keep an open mind to it, but again, without the visibility there, the earnings, it's pretty hard to form a view on the valuation of that at the moment. Fortescue, keep an eye on this as if we do see a softer period in US markets and iron ore trades back below that $80 level, and you see Fortescue maybe sub $10, so and that'll tie in with an entry opportunity there. Rio Insurance Australia, not being there, cautious on the insurance company, especially QBE. We're seeing increased pressure on US lawmakers to review these policies and the rulings where there's limited room for the insurance companies to wriggle out of payments around exclusions in insurance contracts for businesses that have been impacted by this COVID pandemic, and QBE is right in the centre of that, so I think they're sort of building concerns there, and we just keep away from QBE because of that. Orica at around $16, I think add that one to your watch list and certainly think about that. Not doing there in Challenger or Alumina at the moment. So Seek sub $15, you can make a note of that. Beach Energy not doing there. Flight Centre. Evolution Mining, so you may recall from the beginning of the presentation, it was removed from the model portfolio. So just to follow the logic of what it's doing there, it switched from sell conditions into buy conditions back in 2018 at $2.80. So at that point, it's added into the model portfolio. It stays in the model while it's under buy conditions, and then eventually, when it switches to sell, it gets removed from the model. So Evolution's been removed, Northern Star and Newcrest remain in the model. A2 Milk, not there at the moment. WiseTech, so you can see there, so here's a classic example where a stock's been in a strong uptrend. It's in the algo model while it's under buy conditions, which are the green markers at the bottom. As the momentum starts to falter and it rolls over, it switches to sell signals, and at that point it's removed from the model portfolio. Night Entertainment under sell conditions. So now what we've done is we're moving through the watch list. We've gone through all the stocks that are under buy, and now we're looking at stocks that are under sell conditions. So if you run a trading account or you look at the shorting the market, these short signals are tools that you could use to assist with that. So ANZ's been under sell signals there from $27. AusNet, not really doing anything there at the moment, but you can see there the sell signal. Aurora, so we've been cautious on that for a while. We've seen deteriorating earnings trends. Treasury Wines, we've been cautious on that and ensured that's removed from portfolios. The index itself's under sell conditions. Suncorp under sell conditions there at around $14. We've ensured that's not a holding in portfolios. Charter Hall not doing there at the moment. Stockland under sell conditions, so cautious on that still. Whitehaven Coal's been under sell conditions there from around $5, continuing to move lower. Scentre Group's been under sell conditions there from around $4. Spark Infrastructure's under sell conditions. AGL was under sell conditions there at around $21, so continues to move lower. I don't think the downside risk's too significant there in AGL. Domino's under sell conditions, but it's continued to push a little bit higher. It trades on a high PE, Domino's, but maybe it beneficiary from increased business in this environment. Link Administration's under sell signal there, so comfortable with buying Computershare, but cautious on Link. Tabcorp. So this is one of the sort of more recent sell signals. The bounce back in Tabcorp. We've seen a sell signal there at around $3.30. So the stock moving lower. So as long as this short-term indicator continues to sort of point down, it's something that traders could have a look at on the short side. Unibail not doing there at the moment. Vicinity, all these property stocks are just hard to get visibility on their earnings and understand what the bad debts position looks like. Reliance Worldwide not doing there at the moment. Woodside Petroleum, so we had the sell signal up there at around $35. It's continued to move lower. We've had the bounce back. On the buy side, our preference is Origin over Woodside. So Crown, we've seen in the media Blackstone has taken an equity stake, bought Melco's interest in Crown, and there's increasing speculation that Blackstone will look to help facilitate one of James Packer's earlier business plans, which was separating the property side of the business from the casino or hotel operation, and it would be a leaseback arrangement. When looking at it on a separated basis, the property portfolio at about a 6% yield in the hotel business, it unlocks a shareholder value of around $12, maybe $13. That's in a good environment, it seems. So at around $9-10, I would think that Crown's getting back to fairly full value for this operating environment, especially given the uncertainties of the losses that accumulate. Bank of Queensland under sell conditions there, so not doing anything there at the moment. Boral, so this is a stock that is worth tracking. It's under sell conditions at the moment, but the sell-off that we have had from around $3, if we see it back down sub $2.50, we'll start to take a closer look at that. There's not many stocks that we buy that are under sell conditions, but occasionally there's something there that seems to tie in with with the longer term fundamentals. And Boral and CIMIC are two companies that are worth just keeping an eye on, because I think the fundamental story for those could support higher share prices, and if we get a chance to buy either or both of those at lower levels, I'll update you on the blog. Incitec, just resistance there at around just under $2.50, so it's been under sell conditions there since $3.40 and it's moved lower. South32's been under sell conditions from $3. Luca Resources, resistance there at around $8. So all these names we're avoiding at the moment and ensuring we're not holding them in portfolios. So Worley at around this $16 level was resistance, and Worley may have some sort of more significant issues that they face over the next 6 months. So I'd be surprised if I'd expect to see this maybe take out those lows. So again, we'll keep an eye on that. And there we are, Virgin and back to the original. So just to recap the stocks that hopefully you made a note of as we went through tonight's recording. So Newcrest Mining, Woolworths, Coles, Brambles, nice to pick it up a little bit cheaper, maybe back near $10. Sonic Healthcare, recovery opportunity, and between that $25-26 level. Amcor, something you can look at on a dip. Cleanaway at 170. The technology stocks still seek CAR and REA, but CAR over the other names. Orica at around $16. I think keep an eye on that and just run a tight stop loss below there. CAR we've spoken about. TPG back below $7 is on the radar. Origin we like if we're looking for a recovery play to energy prices, so Origin over Santos or Woodside. BHP's partly a recovery on energy, but again at the moment iron ore prices seem to be under a bit of pressure, and if the US market struggles, I just don't see BHP and Rio ready to rally, which then has impact on the XJO because there's little support by the banks or the resources in that environment, so it's hard to see how the XJO goes higher. REA Group, keep an eye on it. It's more of a buy on a pullback. James Hardie again, so keep an eye on it, but it's a buy on the pullback. Coca-Cola at around $8, I think. So these sort of more defensive names, Woolworths, Coles, Coca-Cola, you can think about adding covered calls to enhance the income there. Maybe Caltex again, just run stop losses, but keep an eye on that. Cochlear at around that 180. Xero we're not doing too much in at the moment, but around that $75 level should be support. Now let's look at a couple of things if the market actually struggles, how to benefit from that. So Yank is the beta share strong US dollar fund, so you'd expect the Aussie dollar to move lower and the US dollar to move higher if global volatility picks up. The Yank is now under buy conditions here at around 14.50. It's rallied $1 since it switched to the algo buy condition, so we're continuing to look for that to move higher, and we've started adding that into portfolios. Just a simple way to invert the market where you're profiting from a bear market rather than having to short individual stocks. There's no leverage involved with this, so this is the Beta Shares Australian Equities Bear Hedge Fund. So if the market goes down by 1%, this goes up by 1%. Some of the other products are leveraged 2 times. This is probably the simplest way to think about profiting. If you thought the market was going to be 10% lower in the 6 months, you can buy this and you're going to make 10% out of it. Obviously, the inverse works, that if the market actually moves higher by 10%, you're going to lose 10% on this. But if you don't have, it's something just to have a think about. If you're looking for a strategy in your portfolio to profit from the market falling, you've obviously got shorting of stocks, buying put options, buying or selling futures contracts, index futures, or these inverse ETFs. So again, if you'd like to discuss any of that, don't hesitate to give me a call. And gold. So whether it's a gold ETF or buying Newcrest, so there's some products there to have a think about that will allow you to profit from the volatility picking up in the market and downside pressure re-accelerating. And our obvious concern there is just as we get into those, to the market focusing more on those June earnings, and those numbers being far worse than the markets had to absorb as these March quarter results have come through in the US. So we'll keep an eye on that Nasdaq. That's the reference point. You want to be cautious whilst the Nasdaq trades below that, but that overhead resistance at around 9,000 is likely to maintain there in the US. So it's hard to see the US market moving higher in the short term. Thank you for listening in, and I look forward to speaking again next week.